£1,000. For some people, that represents months of saving. For others, maybe a bonus or a tax rebate. But regardless of where it comes from, what you do with it next could genuinely change the financial trajectory of your life. Not because £1,000 is some magic number, but because investing your first £1,000 isn't really about the money. It's about learning a skill, building a habit, and starting a process that, if you keep going, will compound into something extraordinary. By the end of this video, you'll know exactly where to put that £1,000, what to put it into, and how to think about it so that you never panic and pull it out at the wrong time. Let's do this properly. Before we talk about where to invest, I want to make sure you're in the right position to invest at all. Because for some people, investing £1,000 right now might not be the smartest next step. Ask yourself these 3 questions. 1. Do you have any high-interest debt? Credit cards at 20% plus? If yes, paying that off first almost always beats investing. You won't get a guaranteed 20% return from any investment. Eliminating 20% interest debt is as good as getting a 20% guaranteed return. 2. Do you have an emergency fund? At least 1 month's expenses in an easy access account. 3 to 6 months is ideal. If you invest £1,000 and then your boiler breaks or you lose your job, you might be forced to sell your investment at a bad time. 3. Is this money you won't need for at least 5 years? Investing is for the long term. If you might need this money in 18 months for a house deposit or a car, keep it in cash. Markets can drop significantly in the short term, the key is staying invested long enough for them to recover and grow. If you've ticked all 3 boxes, low or no high-interest debt, emergency fund in place, long-time horizon, then you're ready. Let's go. In the UK, the single best account for most beginner investors is a Stocks and Shares ISA. We dedicated an entire video to explaining how it works, but here's the quick version. Inside a Stocks and Shares ISA, your investments grow completely free of income tax and capital gains tax. You can invest up to £20,000 per tax year. Once the money is in and invested, it can grow tax-free indefinitely. For your first £1,000, opening a Stocks and Shares ISA is almost always the right move. The tax protection costs you nothing and benefits you enormously over time. Now, where to open that ISA? Here's a straightforward breakdown for beginners. For simplicity and low fees, Vanguard Investor. Their platform charges 0.15% per year, capped at £375. Their own funds are some of the cheapest and best diversified available. The only downside, their investment options are limited to Vanguard funds and ETFs. For most beginners, that's not a problem at all, they have everything you need. For slightly more investment choice, InvestEngine. Very low fees, great for ETF investors, a clean interface. For maximum flexibility, Hargreaves Lansdown. The UK's most popular investment platform. Charges 0.45% on the first £250,000. Higher than Vanguard, but for a £1,000 portfolio, the difference in real money is minimal, we're talking about £1.50 per year difference. For your first £1,000? Any of these 3 will serve you well. I'd lean toward Vanguard for a first-time investor who wants the simplest possible experience. This is the part most beginners overthink. They spend hours researching individual stocks, trying to find the next Amazon or the next Tesla. They worry about getting it wrong. Here's what I'd actually do with £1,000, and here's why. I'd put it all into a single global index fund. Something like the Vanguard FTSE Global All-Cap Index Fund, or the HSBC FTSE All-World Index Fund. These funds give you exposure to thousands of companies across dozens of countries, large companies, medium companies, developed markets, emerging markets, all in one product. The charges are extremely low, typically 0.12% to 0.23% per year on the fund itself. At £1,000, that's £1.20 to £2.30 per year in fund charges. Essentially nothing. Why a global index fund rather than, say, a UK-only fund? Because the UK stock market, the FTSE 100, is heavily weighted towards certain sectors, banks, oil companies, mining. A global fund spreads your risk across the whole world economy. When the UK underperforms, US or Asian markets might pick up the slack. And the data backs this up. Over the long term, global index funds have consistently outperformed the vast majority of actively managed funds where a team of expensive analysts tries to pick the best stocks. After fees, they almost always lose to the index. A quick word on individual stocks. Buying shares in a single company, say, Rolls-Royce or GSK, is not wrong. But it's riskier than a fund because all your eggs are in one basket. If you want to invest in individual companies, that's fine, but I'd suggest keeping it to a maximum of 10 to 15% of your portfolio, especially when you're starting out. The core of your portfolio should always be the broad diversified fund. Think of it this way, the fund is your foundation. It's solid, boring, and incredibly effective. Individual stocks are your optional extra layer, interesting, potentially higher upside, but higher risk. Your risk tolerance should match your time horizon. If you're investing this £1,000 for 20 or 30 years, you're 25 and thinking about retirement, you can afford to take on more risk. Over decades, markets have always recovered from crashes. You have time on your side. If you're 50 and this is for retirement in 15 years, you might want a slightly more balanced portfolio, some equities, some bonds, to reduce the volatility as you approach the point where you'll need the money. For a complete beginner in their 20s or 30s, a 100% global equity index fund is entirely appropriate for long-term money. Don't let the short-term noise spook you. Once you've invested your initial £1,000, the most powerful thing you can do is set up a monthly direct debit to invest more. Even £50 a month. Even £25. Regular investing takes away the temptation to time the market. Some months you'll buy when prices are high. Some months you'll buy when they're low. Over time, this averages out. It's called pound cost averaging, and it's one of the most reliable ways to build wealth steadily. Set it up. Automate it. And then let compound growth do the heavy lifting. At some point, you're going to open your app and see that your investment is down. Down 5%. Down 15%. Maybe, in a serious crash, down 40%. This is completely normal. Every investor who has ever built significant wealth has lived through multiple market crashes. The 2008 financial crisis. The 2020 COVID crash. They happened. Markets fell dramatically. And then, without exception, they recovered and reached new highs. What do you do when markets drop? Nothing. Keep your direct debit running. Don't sell. Don't panic. In fact, if you have extra cash, buying more when markets are down is buying at a discount. The investors who make the most money are the ones who stay calm while everyone else is selling. This is the hardest part of investing. Not the picking. Not the platform. The psychology. And knowing in advance that drops will happen, and planning to do nothing about them, is the most valuable preparation you can make. Before we wrap up, let me show you why starting with £1,000, even if that's all you ever invest, still matters. At 7% average annual returns, roughly the long-run average for a global equity fund, your money doubles approximately every 10 years. The rule of 72, divide 72 by your return rate to find how many years it takes to double. At 7%, £1,000 becomes roughly £2,000 in 10 years. £4,000 in 20. £8,000 in 30. If you're 25 today and you leave that £1,000 untouched until 65, you're looking at around £15,000 from a single initial investment. Now add monthly contributions on top of that. The numbers become genuinely life-changing. That is why starting matters more than how much you start with. Your first £1,000 invested is one of the most important financial decisions you'll make. Not because of the amount, but because of what comes next. The habit. The mindset. The system. Open the account this week. Put in your £1,000. Set up a monthly contribution. And then step back and let time do its thing. Hit the like button if this helped, subscribe for the full series, and let me know in the comments, have you already started investing, or is this your year to begin? I'd love to hear from you. See you in the next one.